Netflix just reported earnings and the stock jumped 11% to $545 a share. That gives the company a current market cap of $242 billion. There's $7 billion of cash on the balance sheet and $15 billion of debt, so the enterprise value is just under $250 billion. There is no denying that this was an excellent earnings report from Netflix. Paid memberships increased by 13% to 260 million users, which was 4 million more than expected. Growth was seen across all regions, including North America, and total revenue increased 12.5% to $8.8 billion. The company also gave an optimistic forecast. Revenue is expected to grow another 13% next quarter, and Netflix's operating margin should climb to 26%. Over the last 12 months, the company has generated $34 billion of revenue, $5.4 billion of net income, and almost $7 billion of free cash flow. So the stock is now valued at 44 times earnings or 36 times free cash flow. Reading this report, there isn't much to criticize. There's growth across the board, and the company's journey into paid advertising is going well. Netflix is clearly dominating the streaming industry, and if it can continue this type of performance, the stock is likely to move back to all-time highs. The one sticking point is that Netflix cannot afford to rest on its laurels. To maintain its dominant position, the company needs to continue to invest in new content. The company expects to spend $17 billion this year and just signed a deal worth $5 billion to stream WWE Raw. So it's clear that Netflix wants to move further into live TV, sports and gaming. That seems like a winning strategy so long as Netflix doesn't dilute its brand in doing so. Let's assume Netflix can grow its top-line revenue 12% per year for the next 5 years and operate with a net income margin of 22%. In that scenario, the company would be producing $59 billion of revenue in 5 years' time and $13 billion of net income. A 30 times multiple takes the valuation up to $392 billion, include a reasonable number of share buybacks, and the estimated return is around 12.4% per year. That's quite a good return, but is there a ceiling on potential growth? Netflix management put its current addressable market at over $600 billion, so the company already occupies 5% of that figure. There's no doubt room to move higher, but the stock also doesn't have too much margin of safety at this price. As a result, I rate this stock a cautious buy, but these are my personal opinions, not financial advice, and I hold no position in Netflix. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.